Ross Kenneth Erkin here, a personal finance editor at TheStreet.com and the editor of MainSt. Today I'm joined by Brandon Coughlin, president of Education Finance at RBS Citizens Financial Group. Thanks for being here.
Sure, happy to be here.
So we have a little bit of a deadline ahead of us. July 1st marks the legislative deadline for the interest rate hikes of Stafford loans. You deal, though, in private loans for education, right. And I want to know fixed and variable, what is the best structure for students to take, and what is the advantage in the first place of a private loan?
So one big difference in private student loans is that as a bank, we underwrite the loan for the student. Many times that means the parent needs to be attached to the student as part of the loan because they've got the income in the household typically, unless the student is employed while they work. And so as a result of that, we are able to give prices that are potentially different at times than the federal loans do offer, particularly since the parent is attached to the loan, whereas not always the case on the federal side. So from a student's perspective, we always encourage them to really do their homework related to all their options that are available to them. There are some subsidized federal programs that we always encourage the student to take first and foremost, including the Stafford unsubsidized loans, which is a part of the legislative discussion right now. Once you get past that, if you still have a need for further financing, it's really important that the student and the family really evaluate all their options. Fixed and variable, both are options that are provided today by most banks, including Citizens. And really it's a personal decision for families. A lot of times the fixed rate can actually be lower than some of the Federal Plus programs. It depends on your credit score. And you really have to think about more than just rate. It's also fees. And some products have fees. Most lenders, banks, do not offer fees with their programs. So that's something to consider as well.
A lot of students get out of college and they realize the extent of the debt they've accumulated. Is there any way to combat that trend and that sticker shock?
Yeah, I think it's getting back to doing your homework, and in this context, it's around the cost of education. It's something that we can't control as a lender, but we really encourage students to take careful thought as they plan for school. What degree do they want to get? How much do they think they're going to earn when they get out? Is tuition, the tuition for that particular school, worth it? And then you make the decision on how to finance it. Is it debt? Is it do you have the money at hand? And really pre-plan for that. The key is not to have a surprise when you graduate, and make sure that you're ready for the debt that you've taken on.
And that calls to mind the question of the ROI on education these days. You know, is it worth it?
Well, look, I think that education is still very much a part of the American dream, and I think most statistics would say that the further you go in education, the further you go in your career. So I think absolutely it is, but it's not a general statement that can be applied and sort of a truth no matter what. It's very important that you do evaluate the quality of the school, the degree that you're going after, and is that particular cost for that school, for the degree that you want, worth it? Is really a better way to think about it than is education worth it in general, because it is. Education is absolutely worth it, but there are some nuances in it. It really takes some careful thought and planning from the whole family to really make sure that they're making the right decisions as they sign up for the particular university or school that they go to, as well as how they structure, how they pay for it.
Brandon Coughlin, thank you so much for being with us.
Sure thing. Thanks for having me.